Hello and welcome to the March edition of TaxTixs. We're really excited to be here today and we've got a few interesting things to bring to you. So with the approaching of the new tax year at the beginning of April, Adam is going to be talking about the advent of making tax digital for income tax, what that means, what the quirks of that are. So listen in for more detail. Then Tim is going to be talking about some recent shenanigans at the High Court that Mr. Kamal brought against Dan Neidle. Many of you will unlikely have heard of Dan Neidle and his tax mission. So more details on that. And then finally, I'm going to be talking about some good news in terms of fuel and charges. So what with everything going on politically around the world, it's not great news for people at the petrol pump at the moment. But if you have electric vehicles, there is some good news to share. So a packed agenda today. So I will now hand over to Adam to talk about MTD.
Thank you, Kelly. Yeah, for those of you who are a bit confused, it is March, it is 2026. It is quite a long time since MTD for ITSA was due to come in. I forget which year it was meant to actually get implemented. It was certainly 2, 3, 4 years ago that we were expecting to be here having this conversation about what you need to do from April. So here we are. March, once Easter's out of the way and everyone's had a lovely break, you then need to start rethinking about how you file your taxes if you're self-employed or have rental income. So MTD for ITSA, there's been a lot of HMRC campaigns around of late. You've probably seen TV adverts, radio adverts, online stuff, or anyone who gets a newspaper may have seen it in print media as well. So they are trying to make sure that everybody knows about it. And we as accountants, tax advisors are doing what we can to bring it to our affected clients and to the wider world, such as your good selves, via our podcast. So what is MTD for ITSA? Making tax digital. I mean, it is kind of what it says on the tin. You have to do your tax stuff digitally. A lot of people will be wondering what this really means in the sense that you do your tax return online, or people who file VAT returns because that went digital a while ago, but you're ahead of the curve. Yeah. For those of you who are using computers, doing your tax stuff on there, then the digital aspect of it may seem a bit odd. But fundamentally, what's happening from April is that there will be a requirement to keep digital records. And this doesn't just mean using an Excel spreadsheet necessarily to keep records of your business. This means using a compliant piece of software. So something like Xero, QuickBooks, to name a couple. Other softwares are available. Ensuring that your records are maintained on that digital software rather than just having it. It's no good. Yeah, just having the software and not putting anything on it. And then you need to provide information to HMRC on a quarterly basis about each self-employment and each property business where you're caught under the new rules. That is the nutshell of it, really.
What are the thresholds for the new rules?
It's coming to those.
Okay.
So
jump the gun.
The thresholds, we do look backwards like we do most of the time with tax. So looking at the 24-25 tax year, so the year ended April 25, if your income from a sole trade or from property or a combination of the two was in excess of 50,000, then you need to register from April this year. That will be extended from April 20 with relevant income, so property and sole trade above 30k. And then from April 28, that threshold drops again to 20k, by which point I would expect anyone with a rental property or any sort of self-employed business to be within this MTD for it. So
yeah. Okay, so it's a gradual phasing in.
It is a gradual phasing in.
And that's income, not profit.
It's income, not profit. So yeah, gross invoiced amounts or gross receipts from rental. So the filing deadlines, it's quarterly. April start. So the first quarter end, May, June is the end of June. It's the 5th of July, in fact. Or if you want to use calendar quarters, it's 30th of June. And you'll have to file that by the 7th of August. So the first real deadline for people is 7th of August. Forgetting or not forgetting, of course, that you need to register with HMRC prior to 6th of April. It's not your self-assessment registration. It is a separate MTD registration. So you need to get that done before April, make sure your software is up and running. Make sure you put all your records through the software and then get your first return in by the 7th of August. The good news is there are a number of exemptions. Some of these are frankly ludicrous, but I would take an exemption if you can get it. The obvious one, anyone who is receiving income from a trust or an estate, regardless of the level of your self-employed income or your property income, you do not need to be within MTD for ITSA. So if you get £1 of income from a dead grandma or something like that still trickles in every year, you don't have to worry about MTD for ITSA, regardless of what your other incomes are. So that's good. Easy get out for a lot of people, maybe. The other one is anyone who's using averaging adjustments. Now, you're probably going to ask me what on earth I'm talking about. If you are a farmer or you've got artistic income, so you're an author or you're likely to know what averaging is. If you don't know what averaging is and you're not a farmer or an artist, you probably don't need to worry about it. But yeah, a freebie for those that can average. We don't need to worry about it. Again, people in receipt of qualifying care income. Again, if you get this, you'll know what it is, but broadly it's foster carers. So foster carers are outside of the MTD for ITSA regime. And anybody who is non-UK resident or for any other reason has filled in the residency pages on the tax return in the last few years, you do not need to be involved or you're exempt from MTD for ITSA. So it's quite a large group of people that don't need to worry about this. We've seen...
Is that just for this year or is that ongoing, those exemptions?
Those, they're April 27 as a minimum at the moment.
Okay.
I wouldn't be surprised if they get extended again, but for now, yeah, don't worry about it. And maybe from April next year.
So check in again and do next year, basically.
Yeah. Keep an ear out for our podcast. We'll tell you all about it. The other big group that's exempt are partnerships. So for those of you in the know, partnerships are transparent for income tax purposes and the partners are subject to income tax. So one would assume that making tax digital for income tax self-assessment would include partnerships. It doesn't. So partnerships, there's no need to do any quarterly reporting whatsoever. And similarly, companies are excluded, but that kind of makes sense because they're subject to corporation tax.
And then can I just ask, Adam, so with the registering for MTD, is that sort of like a prolonged process where you submit an application and have to wait an amount of time, or is it instantaneous, or do we not know yet?
We do know, we have done them. I haven't personally, so I can't tell you with any great certainty, but it is just an HMRC online form. So you'll be required to log in through your hmrc.gov.uk gateway, click the links. I mean, if you just Google or other search engine, register for MTD for ITSA, it will take you to the right HMRC site, probably drop in your national insurance number, maybe tax reference number, and it'll take you to the registration process. But it's relatively painless and we can do it for you if you want to sign up with us for MTD services. So yeah, I mean, in short, what do you need to do? How do you comply? Register, as we've just discussed. Make sure you get your software. Like I say, Xero, QuickBooks are the sort of main ones, but there's plenty of other MTD compliant software out there. What I would say is for us as accountants, we tend to push Xero and QuickBooks just because we feel they're kind of the market leaders and we use that. So if you're wanting help from us with your MTD filings, please use Xero or QuickBooks to keep your records. Otherwise, it makes it a headache for our teams to pick it up, and ultimately it'll just end up costing more money. So using the right software works. For landlords, Xero, QuickBooks, they're perfectly good, but there is specialist software, or various specialist softwares out there that are targeted towards landlords and landlords only. And the one we're advocating is Hammock, as in the nice thing that you'd lay in on a beach. That seems to be the go-to software. And again, we've got an account with them. We're able to assist if you're using that. If you've got another bit of kit, sure, we'll work it out, but we've got expertise in-house in Hammock, so we can better help you if you follow the same path. And we're not on commission, just to be clear. And yeah, we can help with any of it. So quarterly submission, we can do your bookkeeping if you want us to. We'll do your tax return still at the end of the year, which still needs to get filed, which brings me to another point that's really important. Whilst you're doing quarterly filings, there is no quarterly payment, which seems a bit counterintuitive. So your tax payment deadlines are still 31st of January and 31st of July each year. There's no payments which need to be made connected to the quarterly filings, 7th of August, November, etc., etc.
Yeah, probably need to add into that. Yeah, I think
Yeah.
that's the direction of travel, I'm sure.
Which
That's for information purposes, HMRC, I guess, then, at the moment.
entirely, yeah. I think when this was first mooted, wasn't the argument that those of us who are on pay as you earn, you pay your tax monthly, and why do the self-employed and landlords not have to do that? And they basically get
bit of it as well. My understanding was that they, rightly or wrongly, just the messenger here, HMRC believe that owner-managed businesses miss more tax than anybody else. They're saying their records are not up to scratch and therefore they're not paying the right amount of taxes. So the idea behind MTD was to force good record keeping. And therefore, in their heads, that means the tax gap will go down and people may pay more tax because their records are correct. Whether there's any truth to that, I don't know. But they're saying the VAT exercise has proved that to be true. Apparently, their VAT take has gone up, but it's just based on records alone. Maybe there is something in it, but that's part of the logic behind it, I believe.
Well, it's not an increase in GDP, is it? So it must be something that's driving up the VAT take.
Yeah.
But yeah, that's MTD in a nutshell. I could go into a lot more detail and bore you all to tears, but I think that pretty much covers the salient points. And if anyone got questions, then reach out to us through the links that you can probably click from this podcast. And yeah, we'd be pleased to help you.
Right. Thanks for that, Adam. And so hopefully everyone's prepared for what to expect from April now. Yeah. Okay. So Tim, Dan Neidle, what trouble has he got himself into recently, or not?
Or
It's the
not,
High
as the
Court
case may be.
advised.
Yeah. So yeah, no, this was just a quick one, really. I just thought this was an interesting case. So Dan Neidle, he basically runs a not-for-profit organisation that's an investigative journalist, effectively, that he goes around and looks at what people are doing in the tax industry, and just holds people to account, effectively. Is what he's really trying to achieve. And he's an ex-head of tax at Clifford Chance, so he has a very good pedigree. But having left there, he's set up on his own, as I said, set up this not-for-profit organisation that he's looking at these things. So he came across one scheme where he questions the viability of it. But behind this scheme was a tax barrister who had signed off on it and said, yes, it works. Mr. Neidle begged to differ. The barrister then effectively sued him for libel and said, because you've said all this about my scheme, the clients that were due to come and sign up for it haven't, and I want 8 million quid off you for loss of earnings, effectively. The case went to court, as you expect. They didn't settle this one because Mr. Neidle suggested, I've done nothing wrong. It didn't even really get past the first stages, to be honest. At the initial hearings, they issued what I believe is called a SLAPP. I can't remember what the acronym stands for, but it's
a strategic lawsuit against public participation.
Oh, well, there you go. So basically, you're saying you're trying to basically, sue him just to get money out of him, thinking that he can't afford to defend himself. I suspect that means. So effectively, the case didn't even go to a full hearing. It was just dismissed in its entirety. Mr. Neidle is now off the hook. However, he did publicly acknowledge that case cost him £146,000 to defend himself against. He didn't have that means behind him, considering this is supposed to be a not-for-profit organisation as well. Then, you think, would justice have been served in this particular case? I don't particularly want to comment on the barrister in question too much because clearly he's litigious, so I don't really want to say too much there. But I think it's just interesting that these sort of tax schemes still are out there, and there's other things that he's been looking at. He did quite some interesting pieces on R&D, but then just today he's been looking at incorporation of property portfolios, which you'd think is a fairly vanilla thing to do. But there were some providers out there who are encouraging people to incorporate property portfolios in such a way that sort of bent the rules a little bit, should we say. I think they were a little bit aggressive in their interpretation of the rules. And today, that one particular provider has turned around and said, we are no longer doing incorporations of property portfolios due to a change in stance from HMRC, and not from the fact that what they were doing is just wrong. Yeah, there's some interesting stuff out of that. It just seems odd to me in this day and age that people are still trying to come up with tax schemes, considering we've had a general anti-abuse rule since 2013, which basically means if you do anything to try and avoid taxes artificially, then they can just look through any steps you take to see what's actually happened economically.
Good point.
So,
Tim, just to sort of step in. I mean, we do a lot of tax advisory, and we have worked with people to incorporate property portfolios. And I'm aware of some of these schemes that Tim's alluded to, and they're trying to overcomplicate a situation to engineer a result that they want. What I'd say to anyone who's considering taking some action for tax planning and is being pitched a proposal that's kind of cookie cutter by a firm, make sure that you really understand what it is they're trying to do. And if it seems excessively complicated, there's a likelihood that what they're doing is not quite accurate and it could come to bite you. So if that's the case, come and talk to us, come and talk to your accountant, day-to-day accountant, tax advisor, and just get them to look at it. We call it a sniff test. If it doesn't smell right, it's probably not. You take the chicken out of the fridge. If it smells off, you throw it away. And I'd encourage people to do that with tax planning, and then come to us, come to the butchers and get a good bit of meat that can do the job properly and not give you food poisoning down the line.
Indeed. Good analogy now, Adam.
Yeah.
Well, especially in barbecue season coming up.
Also, the Dan Neidle case was apparently the SLAPP, that acronym, was one of the first times it's been used under the Economic Crime and Corporate Transparency Act. It's where its legislation is aimed at avoiding silencing or intimidating actions rather than encouraging such information to be brought to the public.
Right.
Quite interesting, and to see it successfully used there.
Sounds almost Victorian, doesn't it? Back in the day where you hit someone with a glove when you want justice.
Yeah.
Be quite a nice way of fun.
Yeah, it's interesting that the acronym actually is SLAPP, which is kind of what it's doing, isn't it? Slapping it back.
Slapping you down, yeah.
Yeah. Okay. So just really to bring this to a close, it's just a very quick summary of a VAT case. Obviously, I have an interest in VAT, so always want to bring you anything topical on VAT. And it's really just because we're also thinking about the rising cost of fuel at the moment with what's going on in the world. So quite topical. And this case was around whether the supply of electricity through public charging points should be subject to VAT at 20%, or should benefit from the reduced rate, which is applicable to the supply of domestic fuel. So if you receive fuel in a household, that would be subject to the reduced rate of VAT. So you'd only pay 5% on domestic receipt of fuel in your home. But conversely, where you charge a private vehicle through a public charging point, up until now, that fuel has always been supplied at the standard rate of VAT, so being 20%. And this put individuals at a disadvantage. So say, for example, you live in a block of flats and you don't have a drive or a house where you can install your own personal electric charging point. It means that you're paying 15% more VAT than those who are lucky enough to have a charging point on a drive. And for a long time, HMRC have said that, well, public charging of EVs can't be subject to the reduced rate because it's not being provided at domestic premises, and therefore it's not domestic fuel. But there is also a de minimis limit on the supply of domestic fuel, which is that where fuel is provided to an individual and the amount of fuel provided is below a certain amount, I think it's 1,000 kilowatt hours a month, then that qualifies as a domestic supply of fuel. And the First Tier Tribunal agreed with the appellant, Charge My Street, in this instance, saying that yes, because the amount of fuel that was provided per individual in any given month was below that de minimis limit, it should benefit from the reduced rate. So that opens up the opportunity for providers of fuel through public charging points to submit error corrections historically, but also going forward to make sure that they charge the reduced rate of that. So good news for the consumer there. And also, if any parties are supplying electricity at the standard rate, come and talk to us. We can explain how to undo the past and treat it correctly going forward.
How does that case apply to other similar supplies of electricity? So I think I'm right in saying that in and caravan parks and the like,
Yeah.
where you're charged for electric, that would be at the 20% rate. But surely this same carve out to get the
Would
5%
apply.
rate should apply.
Yeah, and I think a lot of it is down to how you evidence that the supply is linked to a specific individual and you can monitor that use. So whether, I mean, I don't know whether Charge My Street had specific apps where you put in your information, card details, for example, and then they can link that supply to a certain person. So maybe it's the fact that at a marina or a caravan site, you can't connect the supply with an individual. But to the extent you can evidence that, then there's no reason why it shouldn't be reduced rating.
Interesting.
Yeah, maybe something for us to
Might be
discuss
something
and
to look at.
maybe
Yeah.
detail more in the next podcast.
We could get our own claim. Yeah.
Okay, so I think that about wraps it up for March's podcast. Thank you for joining us, and we look forward to bringing you more next month. Thanks very much.